Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also hosting our webinar for today. Thank you so much for joining us today for our October Lunch and Learn, and we hope you enjoy the session and learn something new. For this month's Lunch and Learn, Graham Wickham, President and CEO of Wickham Financial and Insurance Services, will share with you some information on inflation and whether or not it should be feared or embraced. Hopefully, it's not so scary during this Halloween season. Throughout today's session, if you have any questions for Graham, please type them in the Q&A session of the chat box, and he'll address those at the end of the webinar. And as always, you'll see Graham's calendar pop up frequently throughout the presentation. If you'd like to schedule some time to talk with him, please click on that calendar and select the time that works best for you, and we'll get that taken care of. And now I'll turn things over to Graham.
Hey, thank you, Stacy. I love the lead-in music from Halloween. A little fitting for this period right now as we're approaching Halloween this weekend. But I think better yet, the fear of inflation or the scare of it being present in our everyday lives is something front of mind for each and every one of us. So I wanted to take time today and let's go over inflation and how it's impacting us, how it's impacted earnings, gross domestic product, which we're talking about the economy, if you might, for the United States, job growth, so on and so forth, maybe consumer confidence. And let's explore this. I'm not going to reinvent the wheel today. There's an analyst, Jim Paulson, the Leuthol Group, who we've illustrated and brought in some quotes in the past, great analyst, who put out a very interesting article commenting on inflation. And I thought it would be good to have that a part of our seminar today, or class today, or a lunch and learn. So let's go ahead and jump in. So Jim was pointing out, should hotter inflation be feared or should it be embraced? So even if today's inflation pressures prove transitory, which move through the system, meaning it might not be as high tomorrow as it is today, it's roughly about 5.4%. Now, perspective, right before the shutdown in the economy, we had the inflation at roughly about 2.1% in February, when it was reported February 2020. All right, so it's jumped up a lot. Could it go a little bit higher? What effect would it have on the markets, the economy, consumer confidence? That's what we're going to discuss. But maybe higher inflation could be actually a good thing, and we might have to go through periods of higher inflation. So if we think about the last 15 years, we've had inflation actually rather low. I mean, it's been about 1.9%. And even the developed countries around the world have had consistently low inflation. So really, ever since and right before the collapse in the economy, the Great Recession, the Depression that we went through in 2008 and 9, inflation has been stubbornly low. You know, the Federal Reserve really has a mandate to just keep inflation, its target around 2%. So what we want to think about here as we move through these slides and we talk about it a little bit further, could we allow inflation, or does it make sense for us to allow inflation to run a little bit hotter for this economy, and what effects could it have on the stock market? So if we move a little bit further, let's think about gross domestic product. So remember, that's the economy of the United States. And since 1982, inflation expectation ranges are roughly, it's been about 2%, right? But look at this slide. When long-term inflation was held to below 2.7%, overall gross domestic product averaged a rather low 2%. That's a really low growth rate for the US economy. But when we allowed, if we're looking at a forward 10 years, and let's say we allowed inflation to increase above 2.7%, look at that growth. We've had growth really increase to about 3.5% on an annualized basis. So this slide is really pointing out, and I think you're going to kind of get where we're going here on these next slides, is as we've allowed inflation to increase, you know, we've also have improvements, not just in GDP, gross domestic product, but now let's talk about the job growth, because it's kind of some similar patterns when we compare gross domestic product, and we've gone through periods of rising inflation. So when we saw expectations for inflation below 2.7%, the average annualized job growth was really low at only 0.64%. But when we looked at them at above 2.7%, look at job creation. It really started jumping up to 1.9%. Think about this. When we feel good about the economy, when when corporations feel good about the economy, the consumer is healthy, their buying's good, exactly in the situation we're now, they're creating more demand. They create more demand, right? That's purchasing of goods and services. That means earnings are going to go up. If earnings are going to go up, maybe the prices on those goods and services go up. And if earnings go up, what generally happens to stock prices in the markets? They generally rise. So it does make sense that rising inflation, to a point, as long as it goes up, it's actually very good for the market, gross domestic products, jobs. Now, let's look at it from a consumer confidence standpoint. So when consumer confidence, when inflation expectations were below 2%, we actually saw, a rather conservative consumer. But when inflation kind of went up, but maybe it was in some sweet spots of about 2.7, 3.6, we saw a much more confident consumer, a much better environment. When we move even further, let's think about earnings and where the sweet spot might be. This is a little bit different. So it's going to play both sides of inflation. Remember what I mentioned earlier. When inflation increases, or better yet, when earnings increase, right, for companies, stock prices generally follow, right? So if we look at 1982, and Jim and his team at Leuthol Group were putting these slides together in this article, corporate earnings results had not done well when inflation expectations were either too high or too low. So we're finding that sweet spot, right? So when inflation projections were between 1.9% annualized for the S&P, earnings per share were only 5%. So that's the earnings per share of the companies that are part of the Standard & Poor's index were only 5%. But look, when the outlook of inflation was above 3.6, so the high end here of what they were looking at, earnings per share were even lower. They were only 4.4%. So let's think about the sweet spot. Look at this. When we were looking at inflation rates of about 1.9%, the last 15-year average, to about 3.6%, Jim and his team were pointing out that we really saw earnings per share really up about 9+%. So it's that sweet spot. It's not too low and it's not too high. Because the one thing that we want to really be mindful of, it's not that inflation is a bad thing. It's only bad at a certain point where it erodes confidence by the consumer, if they're going to be able to have enough money to buy the goods and services that they want. Or it might be where inflation gets so high, is it going to start eroding the earnings on the balance sheets for corporations? And then you start to have earnings come down. And remember what I talked about earlier, when earnings are down, stock prices, generally stabilize and go down, because earnings or stock prices follow earnings. Good earnings increasing, generally stock prices go up, so on and so forth. So lastly, and we'll get into some questions and answers, so I want to leave some good time for that today. So basically what we find is that when inflation is so low, we find that consumers, not just consumers, but even corporations, tend to pull back on their spending. They're not buying goods and services. If they're not buying goods and services, then we're probably not going to see prices go up. We're not going to see earnings go up. We're not going to see stock prices go up. Does that make sense for everyone? Hopefully it does. On the inverse of that, there can be a point where it just gets too high and it starts affecting those earnings and whatnot. Now, the point I want to make here before we jump into questions and answers, Stacy, for everyone that's on this call, there is going to be a point where it could be too high. But I think right now, since we're looking at inflation at 5.4, it tends to be transitory. I think we're probably going to drift into that sweet spot of somewhere eventually, maybe over the next year or two, somewhere between 3 and maybe 3.5%, which if we look at Jim and his team's analysis, where was that sweet spot? It's between 1.9% and 3.6%. So if we fall within that sweet spot, it looks like we should still see a strong consumer, strong earnings, hopefully still a strong market. So we'll just have to see what it looks like. Do we want to open this up to questions and answers?
Sure. We have already gotten a couple of questions in. The first one is, should we be concerned about inflation with our investments?
You absolutely should. Let's think about this, and if I think we have some individuals on the call that aren't clients, and we're so excited about you being on this. But if you're a client of ours, you've probably heard us talking about it, preaching about it. Just being aware of how inflation can erode the purchasing power, right? That's naturally what inflation does. So we want to make sure that our investments complement the environment that we're in. So this is where I put this statement. If your conservative money is only making 3% and inflation is 5.4%, what is your real return? Your real return is negative, right? Negative a couple percent. So we got to be mindful of that. I know 5.4% isn't the long-term inflation average. It's going to come down 4, 3.5, maybe in the 3 range. We'll just have to see. Maybe it stays stubbornly higher. I think we have to be greedy in a very good way. We got to get away from the traditional modeling that these traditional modeling portfolios push you in, because what they're going to do is they're going to ask you to grab onto things that are going to underperform and not keep up with inflation, and you're going to guarantee yourself losses at that particular time. So I hope that hits home with everyone. Hopefully I addressed that question.
All right. Okay. Well, our second question is, how long can we expect the inflation to be so high?
Boy, isn't that $1 million question?
It is.
We haven't gotten the crystal ball yet. Maybe that'll come through with Halloween. We don't know. But, I think it's reasonable to expect. I was listening to some economic reports today. I mean, obviously, this is how I spend my time. We're passionate about it. We might be seeing some peaks in the supply chain issues, right? So as long as we have a strong consumer, which we do, we have healthy corporate earnings, which we do, partly because of businesses, consumer. If we get to some supply chain issue or some relief with that, I think that will bring some inflation down, which we could be looking over the next 6 months to a year, inflation drifting back down to the 4 to maybe 3, to the 3.5% range over the next 6 months to maybe 2 years. I know that's a broad range. It's just hard to know exactly how long some of these things that are simply out of you and I's control are going to persist in the system, like supply chain issues.
Right. Okay. And lastly, what investments does inflation affect the most?
Yeah, it can, you hear a lot about, well, if interest rate, I commented before on some of our previous lunch and learns, is that, I talked about the 10-year, right? I'm going to bring it back to this real quick. The 10-year goes up, and if the 10 years goes up, what we've been hearing, or you might be listening to the news, maybe you've seen it in your accounts, you might have seen some of the higher growth names, the higher PE ratio names, maybe the more tech trades, all that kind of stuff, that has been under pressure. So if higher interest rates are moving up, that could negatively affect that side of the market, maybe in a short term, but as long as earnings are good and growing, they can bypass that. The other thing that we want to be mindful of is think about bonds, and how bonds and fixed income or equivalent of are affected with rising rates. So think about this. Think about a seesaw on the playground, right? My terrible analogy to that. So you have the seesaw, if you remember, on the playground, and you have children sitting on each side. And one's jumping up and the other's going down. Let's say the right side of this represents interest rates. The other side represents principal values, right? So if inflation starts to go up, what generally happens? Interest rates start to rise, right? And if interest rates start to rise, that drops the principal values of fixed income or bonds of older bonds. Because why? because someone buying newer bonds can buy them at a higher interest rate today. So maybe they're selling their older bonds, putting pressure on the bond values, putting principal values down. Hopefully that hits home with everyone. But let's look at the inverse. Over the last 10 odd years, really interest rates have been down, if not moderating down. So what's been happening? Bond rates have been moving up, fixed income is moving up, and that's been a very popular area. So stocks have gone up as well as bonds will go up. But I think we're hitting a point now where as long as earnings are there, the consumer is there, I think you got stock prices continue to outperform because they're less pressured by rising rates, where you're going to have more fixed income bonds and bond equivalents. Right? And I'll go into that in just a second, are probably going to be under pressure, having trouble kind of moving up as their principal values maybe moderate or go down. Doesn't mean you don't have exposure. Just understand that risk and make sure it's proportionate within your portfolio, right? When I said bond equivalents, I want to take a second and spin off of that if I can. So bond equivalents, think about it. Anything that kind of looks like a bond. So you get into growth stocks, you get into value stocks, income stocks like real estate investment trust, maybe telecoms, maybe utilities, generally is where a lot of consumers, even the financial professionals in our industry, we're going to maybe grab a little more yield, a little higher interest, because we're not getting that in our fixed income area, right? Because remember, interest rates are down, right? So we're going over there. Well, those areas tend to get more debt on their balance sheets. That tends to be the structure of those companies, from telecom, utility to real estate investment trust that are publicly traded on the exchange. So if they have more debt on their balance sheets and now interest rates are going up and their borrowing costs are going up, that could negatively affect, or you could probably see how that can negatively affect earnings, right?
Right.
And if it negatively affects earnings, wait for it, what generally happens to their stock prices? Maybe moderate, maybe don't go up as quick, maybe they go down. Now, it's not a one-for-one. Don't quote me on that. But it generally is what's going on. So it's something that I think everyone needs to be very mindful to not just do a blind model in the portfolio, like take your age minus 100 and that's what you should be in fixed income. Because I think if you've done that in this environment, you're going to dramatically underperform, while everyone else that has maybe a little more responsible stock exposure is outperforming. So I think there's a balance to this. I think it's a more active approach that needs to be engaged in less of the traditional modeling that's been pretty popular in our industry, over the last 20, 30, 40 years.
All right. Well, I think that's about all that we have for today. So thank you so much, Graham, for shedding some light on inflation. And I guess it's not such a spooky topic after all, huh?
It's not that scary, is it?
I guess
As
not.
we move into Halloween. Right?
That's right. That's right.
I do want to encourage any of our viewers today to stop by with your kiddos on Friday. Our team loves to get dressed up. We love to hand candy out throughout the office. We have about 150-year-old, 175-year-old, somewhere in that range, office building. So it has some great character to it, and we'd love to see you drop by with your kids. And we just wish y'all a great Halloween. Thank you for being on the call. Feel free to hit my calendar. I'm happy to kind of expand this conversation a little bit further with each and every one of you that were on the call. Also, one other thing that I do want to highlight, go Braves, right?
Yes, go Braves.
All right, we have to do the selfless plug for the Braves. So if you're not a Braves fan, I'm sorry, Astro fans, but it has to be a little Braves today, right?
That's right. That's right.
Super.
Okay.
Thank you so much.
Well, thank you so much to all of our viewers for joining us today. Like Graham said, we hope to see you again next month at our Lunch and Learn for November. Until then, please remember to check out our Facebook page and our website. We do post valuable content consistently, so we would definitely recommend those articles and other valuable information that we post for you. And like Graham said, happy Halloween and go Braves.
Take care.
Thanks so much.